Yes, welcome everybody once again. Good evening, and let me once again also thank for overwhelming response that you all have given. Again, we have some 800, 900 people, coming on this session, and I'm very delighted that all of you are taking interest in impact investment as well. As you all know, that COVID has created a major pandemic, and we are very sorry for those who are trapped in the pandemic, but at the same time, it also gives us an opportunity to do something for the society, for the community, and for everyone around. So, in some ways, it is also a good opportunity for us to do something good beyond whatever we have been doing professionally otherwise. Now, as you all know, impact investing is, I think, Meyyappan and with Nehal will be talking more about it. But it is something that really is becoming the flavor of the day and flavor of the month, I would say, or flavor of the time. Because traditionally we have seen investment mainly for returns alone. And but now you not only want to have good return, but also good impact on the society. And impact is slightly different from ripples. Everybody does something good, but when you have impact, that means it really changes the ball game. It really does something that is beneficial to the large number of people or large kind of issues that are at hand. And interestingly, I think Meyyappan will talk about it, but we had also worked with McKinsey on the impact investment report. And what turned out was that 33% of the investments made gave over 30% return and created impact in addition to that. So in fact, in some ways, it gave better returns than private equity, which was a bit of a surprise. And we have so much to do in this impact arena. Of course, one is about Meyyappan will again speak about it. Nehal will speak on that as well. There are a number of ways to create impact. One is philanthropy, one is CSR, one is the normal kind of activities that you do, and at the same time create impact. So it is very important to now integrate the whole landscape, particularly in relation to the tax laws, because the taxation of trust has become very onerous. The taxation of CSR also has its own issues. It's not deductible. Number three, that today close to, I think, 25,000 crores come into the system by way of CSR every year. If you want 10% of 25,000 is permitted in the impact investment, for example, in the shares of the impact creating companies, it would really help us a lot. And if you can, streamline the procedure for FCRA and FEMA, we'll get a lot more investment from world over. And all countries have addressed this issue. Why not we? And there is huge amount of capital waiting. Today, maximum investment again is being looked at in the form of impact. And now when the LPs, or what otherwise you call investors in the funds, when the institutions come, they also particularly provide a condition that 50% of the investment which the fund would make, should show impact, and not only impact in general terms, but in a measurable form. And that has become a kind of a prerequisite for all funds when you set up a fund to, incorporate. And even otherwise, whether it is required or not, it would be very helpful for all the funds, companies to incorporate in their own philosophy impact on the society. Because already there was a talk for a long time on stakeholder concept from shareholder, but now after the corporate board roundtable, talked about it, all companies around the world are also talking about the impact and the ESG environment, social governance, and stuff like that. So ESG again is the name of the game, and I'll not delve too much on that at this point in time. But that is another value creator. It is just not in theory. It is not just in textbook any longer. Now this has become a part of the ecosystem. When you want to be a good corporate citizen, as ESG and CSR and impact and all those things are becoming more relevant. So at the board level, we see more discussion on that than many other issues around. So I would not go on for a long time. I would request Meyyappan, now you can take over the reins of this session, and welcome Meyyappan. You've been a great help on the international tax, and of course Nehal, good to see you. You've been also helpful in the past, and I really welcome you. And thank you all for contributing to Liber Amicorum. And I really am grateful to you for your time and effort that you have spent. I'm sure the attendees today will greatly benefit from your conversation. And let's move forward. Over to you, Meyyappan.
Thank you so much, Nishith Bhai. This would not have been possible without your support and your direction in terms of focusing on research in new and upcoming areas. In fact, this is something that was driven by the work we have done at the firm on impact investment projects and what we learned from it. And we've taken a lead from there, and we did more research. And finally, we presented this paper at an academic conference at a university in Sweden last year. And that's how this is been dedicated as a book chapter to you in honor of you in the book. And like I said, all of this would not have been possible without your interest and your guidance and support in making this happen. So we are the ones who are thankful for the opportunity. And getting a little bit into what is impact investment, yes, I will very briefly give an overview of what we plan to do in the session and why it's the topic that is very relevant especially in a time of this crisis. Nishith Bhai, of course, touched upon the different aspects of impact investment. And I think one of the first things that we're going to do in this space is to understand the different concepts that are in the impact space, because many times these words are used interchangeably. But we went back to the academic literature and also tried to see how it's used in practice. And we have culled out several concepts within the impact bucket, which I think will be helpful in understanding how this should be regulated and what are the policy tools from a tax policy perspective as well, in addition to other legal changes which can help the sector thrive. So the other thing I wanted to mention before getting into the conceptual part is to say that one of the things that drove impact investments is that it was meant as an evolution or an improvement over previous models of doing charity and of making investments. It was meant to be like a via media, which was better than both traditional charity and traditional investments. We'll get into the reasons as to why a little bit into the session. But what that has effectively resulted in is that what impact investors and what the models try to do is to maximize the efficiency of spendings that, as Nishith Bhai was saying, both results in financial returns and also in maximizing social externalities or measurable environmental or other outcomes. So there are few things that, and these are exactly the sort of things that we need to be focusing at this point in time. And when both the governments or when grantors or donors or investors are looking to make the most returns out of the money that they spend, I think a focus on metrics and outcomes is probably the way forward. And we will come back to blended finance as a subset of impact investment vehicles, which probably is where we see the maximum growth happening in the near future. So having said that, I would like to ask Nehal, who co-authored the chapter with me and also presented it in Sweden, to set out briefly how what is impact investment and how is it related to venture philanthropy and socially responsible investing, as these concepts are quite interchangeably used sometimes.
Thank you, Meya. I'm just going to begin with what impact investment really is. Impact investment is the kind of investment which aims to maximize both financial returns and social or environmental impact, or non-financial returns. Impact investment is therefore intended to be better than traditional finance because it encompasses non-financial parameters as well, such as positive social effects or environmental effects, while calculating returns on investment. Traditionally, returns on investments have been looked at from a purely monetary perspective, but impact investment brings in the angle of environmental and social and governance parameters as well. This term was coined way back in 2007. The Rockefeller Foundation had convened a group of investors, entrepreneurs, and philanthropists in order to determine the main driving factor behind what incentivizes corporations to invest their capital into social and environmental benefits. This group of entrepreneurs then came out with the concept of impact investment and coined this term. Globally, there is no single definition of impact investment which is really available or adhered to by everyone. But impact investment is a concept which rests on a spectrum. The spectrum is very wide, with one end of it being socially responsible investment, or SRI, and the other end of it is venture philanthropy. Now, SRI specifically excludes sectors which do harm in the sense of social harm or environmental harm or governance harm. SRI therefore embraces the integration of ESG factors into their long-term financial planning. SRIs analyze a company where they're investing into and focus on positive financial and non-financial returns. This is one end of the spectrum. The other end of the spectrum really is venture philanthropy, which emphasizing on investing funds into startups or innovations or fast-growing organizations, and where the risks are fairly higher. Because the ultimate goal of venture philanthropy is to increase impact by supporting innovation, even if it comes at the risk of failure. And venture philanthropy helps identify different strategies which would lead to effective, sustainable social and environmental change. Venture philanthropy, as the word denotes, is not really a profit-making model or mechanism, and simply aims at re-earning the grant which has been provided by the venture philanthropy organization. To that extent, impact investment is neither purely philanthropy, since it does aim to make muted returns on its investment, as opposed to traditional returns on an equity or debt investment. However, the concept of impact investment is also not so narrow that it falls within SRI, because SRI restricts itself to the passive idea of not doing any harm, rather than having a positive obligation to invest in enterprises which specifically create impact in the social sector. Thus, impact investment tends to track financial and social environmental performance across portfolios. So generally what impact investors tend to do is agree on metrics or to which impact will be measured. On several occasions, we have seen that impact investors prefer to be outcome funders, where they make payments based on whether the pre-agreed outcomes have been met or not. On other instances, payments may get staggered or differentiated based on the outcome, but the focus on the social and environmental impact as the outcome is really the bedrock of impact investment.
Thanks, Nehal. So I would like to ask Rahul how the social sector and traditional grant making is different from impact investments, because as Nehal set out, we have looked at venture philanthropy, socially responsible investing, and the concept of impact investment. But Rahul, could you throw some light on how it is different from traditional grant making?
Sure. Thanks, Meyyappan and Nehal, for your comments. Am I audible, Meyyappan?
Yeah,
Yeah.
you are.
Yes. So when we look at today's financing models and when we compare it traditionally with how philanthropy has been, we understand that there have been two buckets now. One wherein we have the impact bucket, wherein investors put in their money for impact along with certain mutual returns and social returns, which has been different from how philanthropy traditionally has been, wherein the monies were essentially supposed to be given by way of a check writing or by way of grant disbursements, wherein the impact of those monies would be to the extent of checks that one writes, and it would be by way of mere disbursements of those monies. For example, typically the way we see CSR funding, wherein companies make CSR contributions to trust societies or such non-profits, and those non-profits in turn deploy those monies on the ground by way of giving it through onward granting to third-party independent implementing agencies or social enterprises. Traditionally, under philanthropy, we have had three types of legal entities that have been more functional in respect of receiving those funds: trusts, Section 8s, and societies. However, post market liberalization, the entire concept of philanthropy has changed a lot, and in India in past decade we have seen a more strategic view of how philanthropy should be carried forward, and there has been a considerable shift in the way philanthropy is seen now. For example, as Meyyappan also will take you through to those nuances. For example, the concept of blended finance. For example, the concept of how we make specific investments, keeping in mind specific social or socio-economic projects, wherein we have an interplay of debt and equity or both. However, in case of a pure philanthropy, the nature of money that comes in and goes out used to traditionally be only by way of a grant making, which now has changed a bit to the extent of allowing private players and impact investors to use that money in a more strategic and in a more targeted manner. Having said that, CSR and pure donor based philanthropy still follow the traditional model of writing checks and deploying it on the ground by way of onward granting. So that is one aspect that we still have in the philanthropy bucket.
Thanks,
Over to you,
Rahul. Thanks, Rahul. So, Nehal, after having heard Rahul on how traditional grant making works, and it's usually in many cases it is check writing. Could you explain how, conceptually speaking, how impact investments seek to improve upon traditional grant making and where some of the deficiencies are that impact investment tries to fix?
Yes, thank you, Maya. Thank you, Rahul. I'll just like to start with some of the problems that traditional philanthropy has as a model, and why impact investment is a good solution to these problems. Firstly, philanthropic ventures tend to be an exercise in inefficient spending, where investments are made by a lot of smaller charities, but they do not create any impact. Due to the lack of accountability or there's high levels of opaqueness in the way the smaller charities function, these charities do not make the best of the capital invested. And the lack of measurement of outcomes also leads to millions being wasted on ineffective philanthropy and on activities which have no impact. Philanthropy as a grant-based model also requires constant fundraising, because once the grant made is exhausted, there is a constant requirement to look for alternate financial avenues to keep the charitable venture alive. In the time taken between exhaustion of older financial resources and finding new grants, there is a stopgap which is created, which may lead to further inefficiencies in terms of impact which may have happened during that time. More than that, philanthropy does not really target structural and institutional problems. As Rahul said, it's simply check writing, which means that whatever problems that are institutional or structural in nature that have put certain sections of the society or economy into positions where they do need funding, those structural and institutional problems are never handled by check giving. And the problems simply get delayed and perpetrated further. Whereas impact investments, because impact investments are long-term in nature and tend to focus on problem solving and outcomes rather than simple check giving, impact investment posits itself as a good sort of alternative to traditional philanthropy. More than that, impact investments focus largely on return on investment in terms of outcome-based funding. Most of the impact investment funds, whether they're non-profit funds or traditional risk investors, have come up with their own standards or metrics of impact, of how to calculate impact. They could take into account, for example, environmental impact, could take into account carbon emissions, or impact investors which are focusing on access to healthcare could take into account exactly how many communities are being impacted by the company in which they have made impact investments. Thus, the further grant and the further investment would also depend in an impact investment model on the outcomes created. Since there is more accountability, there's lack of opaqueness in the structure, there's transferability in the management level. Impact investment is a much better alternative to traditional philanthropy.
Yeah. Thanks, Nehal. So to quickly summarize for the benefit of our listeners, right, what we have basically culled out from the discussions is that under the broad bucket of impact investment, I mean, we have to start, if you want to understand what gets covered, you start off with grant making or traditional philanthropy on the left, and you have the typical for-profit investments on the right. If you take one step towards the center, you end up with venture philanthropy, which Nehal explained, which is one step away from traditional grant making, where you undertake the risk of a whole project with the hope that it supports innovation or a new model that brings about a lot of impact. But at the same time, the risk is that you may lose the capital. And the idea in venture philanthropy is never to make any returns back. It's only to recover the capital, which can be redeployed for further projects. Now, when you take a step away from traditional investment, you end up in socially responsible investing, where the idea is to not invest in harmful things, which could be like investing into companies that manufacture weapons or guns, for instance. And when you take a step away from both venture philanthropy and from socially responsible investing, you come at impact investment, where you expect both social and financial returns. Now, one of the things that I also wanted to point out was that muted returns was mentioned during our discussions, and there are, like I said, multiple views around it. Many believe that impact investments does not necessarily mean muted returns, while several investors in practice do agree to muted returns and muted financial returns in exchange for social or environmental or other non-financial returns. Now, the other thing, which is the good thing about impact investment, is that the focus is on metrics and measurement of outcomes, which means that your money is being more efficiently spent. You can track the spending, track the outcomes, and there is a better way to incentivize or the outcomes by tying money to achievement of certain outcomes. And this results in a more efficient spending, whether it's from a grant perspective or from a investment perspective when you are looking at achieving outcomes on the ground. So, and that's exactly what we need in the current situation. So keeping this in mind, I'd like to go to Rahul to ask him about how impact investment as a concept would differ from how CSR is implemented in India.
Sure, thanks, Meyyappan. So essentially, essentially there's a structural difference between how CSR in the current legal regime is looked at vis-a-vis impact investing. CSR under existing India's law still are to be deployed legally only towards non-profits by way of disbursements and onward deployments. So to that extent, there is a clear restriction in the ways CSR contributing companies can deploy those funds for projects that are scalable and may yield socio-economic returns to that extent. When we compare it with impact investing covers a much broader platform wherein it allows for returns to come in. It could be on a muted basis, or it could be on a basis that are agreed between the parties. Impact investing structure also allow for uh, deployment of principal as well as interest, wherein interest could be foregone, or it could be cross subsidized. There are also ways under which there could be specific targeted deployment of finances, and those returns could be tied to how the monies are deployed on the ground. These specific uh, these specific models are not very much compatible with the existing CSR regime. For example, if today a CSR contributing company were to use their CSR funds to uh, put in their money into a social venture fund, which could then have different risk investors coming together to fund a social project on the ground, that at in the current context that may not be possible. Similarly, there are also specific restrictions under tax laws, which I am sure Meyyappan also will take you through to what those specific issues are. But broadly covering those scope, CSR companies, or companies that use their CSR portfolios, also are not today in a position to invest it into social enterprises. As we know, the nature of social enterprises have also changed manifold, and we also have different hybrid structures now, and hybrid entities that use different kinds of for-profit and non-profit entities to deploy funds on the ground, to execute projects, to implement projects and monitor it. So CSR laws currently are also inhibited by the fact that only a certain class of legal entities are considered compatible to receive those funds, which otherwise is not the case is not the issue in case such monies are to be deployed by way of impact investing. So the bucket of so the bucket under CSR vis-a-vis certain compatible entities are a lot narrower than what we see it in respect of impact investing. Impact investing to that extent allows a more vigorous and a more alternate source of funding, as well as different funding and recipient platforms, unlike CSR, wherein you only have three specific entities that can actually receive funds and use it for further deployment.
Thanks, Rahul. So I think what I'm hearing from you is then that CSR is still very similar to traditional grant making, and there are several restrictions where that the money has to flow only from non-profits to non-profits, and that doesn't really support a impact investment structure where you need philanthropic money to combine with private capital. So before we get into the different other laws, like Rahul had mentioned, there are issues under tax laws, under the LLP Act, FCRA, FEMA. Before we get into the legal part of it, I think what we were trying to first cover is how conceptually, CSR in India is different from what impact investment is, and or how also ESG is different from an impact investment. And to close out that portion of the discussion, I think the CSR, the way it is structured today in India, is that it's a percentage of the profits that the company makes, and that has to be mandatorily spent on a list of charitable activities as set down in the law. And there is no scope for either recovering the capital or for deploying the money in such a way that there is a way to make an incremental return, probably while making a charitable investment. So those things are still not possible. But before we, as I said, get into the legal analysis, I'd like Nehal to share some of the examples that we had examined in the book chapter of how these outcome funding models have worked successfully in other countries, and then we can probably Rahul and I may comment upon what are the difficulties we have seen in replicating that in India due to the legal landscape. Over to you, Nehal.
Sure. I want to take some recent examples of risk investors who have done impact investments and have made returns out of them. Recently, the Global Impact Investment Network, in their 2018 study, had found that over 90% of impact investors had reported that their investments gave returns which met projections, and others met projections beyond the expected. So with that backdrop in mind, there are several traditional risk investment funds which have started impact investments. For example, Bain and Company has an impact fund called Double Impact, which recently announced investment in Living Earth, which is a Houston company which recycles organic waste. Health and wellness and sustainability are the main impact themes that Double Impact Fund targets. The way that Bain measures impact is to use their own impact score, which they have developed by evaluating the impact of a company on all of its stakeholders, including employees, customers, communities, and the planet. Environmental impact was measured in terms of carbon emissions. And further, Bain disclosed that 71% of the companies that they invested in tied management compensation to impact metrics. Another example is TPG, which has a fund called Rise Fund, which focuses on growth equity investments and middle market buyouts. They currently have about $2 billion in their assets under management. They have developed an evidence-based methodology for quantifying the impact of prospective Rise investments, and they have come up with a framework that ultimately generates impact multiple of money. Their investments include investments in companies like Zipline, which is a company which provides emergency healthcare services in affected areas via drones, where other channels of transportation cannot access. Other investments include investments by companies like Acumen Fund into Sproxil, which basically helps users identify counterfeit drugs. And the way that Acumen tracks investments, again, is using impact metrics by analyzing the units or the volume sold, the clients who are individual, like day-to-day users, and the number of texts authenticating drugs as real or fake. The idea is that there are several other concepts such as social impact bonds and PRI in the US, which are impact investment tools which help foundations which helps them make impact investment and also helps them make returns, which currently India in its legal landscape does not allow for.
Thanks, Nehal. So I think to add to what Nehal has said, there are a couple of things that also work in the foreign jurisdictions, which is Nehal had mentioned PRI, which is project-related investment, or we have B Corp, benefit corporations. Now, these are specific legal regimes or concepts that is enabled in the law that allows for deployment of funds in a very different way from what is allowed under Indian law today. So under the PRI regime, you can deploy up to 5% of the foundation's money into a low-cost investment or a charitable investment where you are allowed to make some returns and recoup the capital, but you still have to prove to the tax authorities that the investment is still made for charitable purposes and is not meant to profiteer. Right now, that is not possible under domestic law today. And something like a benefit corporation, which is a special vehicle where if you have set it up for the purpose of providing a certain benefit to the public, then even when the vehicle is acquired subsequently by anyone, the purpose of the company cannot be changed and it has to be run in a very similar manner. So there is a lot of scope for legal innovation to allow for these kind of models to be adopted in India. But it's not that there has been no impact investments made in India currently. In fact, there are several structures on which Rahul and I have advised on in the past as well. And I think I'd like to ask Rahul to step in at this point and briefly give examples of maybe one or two recent structures even to deal with the COVID crisis situation, where we have done a couple of structures, and also to briefly set out what are the legal impediments in replicating these impact models in the Indian ecosystem.
Sure. Thanks, Meyyappan. So, in respect of recent work that we have done on innovative financing, we recently undertook a project wherein we used CSR monies to be deployed for unorganized sector in cases where they would default on loan repayments and where they would fall under the bottom of the pyramid financial platform. On that, we were able to devise a mechanism where we would bring in risk capital which would be used by companies to provide uh, loans to their employees, and in cases of default we could use CSR allocations to make payments for such defaults. Of course, the issue of dehyphenation between the investment money and CSR money would remain, and then there are certainly legal ways to dehyphenate it in a way that the flow of money is structured in order to allow CSR to make those philanthropic givings on the ground, and at the same time use a blended financing model or such financial contributions on a commercial basis to help those bottom of the pyramid populace. At the same time, we have also been exploring different several financing models wherein we could have a mix of risk capital as well as outcome funding come into a single platform. And in situations where domestic CSR contributing companies may also want to participate in those funding models, we could have a mechanism wherein if an upfront risk is undertaken by risk investors basis certain outcomes that are promised to be achieved, a part of those funding can be made by way of outcome funding through the CSR contributing companies. Of course, again, it will have to be compatible with how CSR laws and regime currently are governed under. And at the same time, as Meyyappan pointed out, unlike in the US, wherein we have the concept of PRIs and B Corps, in India, we still do not have that liberal regime wherein companies are allowed to make investments using their CSR portfolios. So we look for ways to devise a mechanism under which we could have an all-encompassing platform which would be compatible to receive CSR money, would also be compatible to receive risk funding as well as outcome funding. Of course, there would also be certain downstream entities that we would require by way of a social enterprise in order to make it compatible to receive CSR funding by way of outcome payment through CSR portfolios companies. But yes, there are ways through which we could have a unified structure which would take care of risk funding, outcome funding, as well as CSR contributions.
Thanks, Rahul. So I think to add to what Rahul has said, we have typically encountered two kinds of impact investments if we were to bucket it in the Indian space based on our experience. One we would call the outcome funding model, where typically the logic is that there will be a risk investor who undertakes the risk of the investment, puts in their 100 rupees upfront, and engages a implementing party or a service provider who will, let's say, educate 100 children on the ground on the achievement of the outcome, which is already pre-agreed before the 100 rupees is invested, which in this case could be that 60% of the 100 children should pass the 10th board exam, something that's measurable as an outcome. And on achieving that outcome, the outcome funder or which are typically foundations or CSR bodies would then pay the money to the risk investor along with a top up which would account for as a return element on whatever the investment the risk investor made. So that is the outcome funding model. The other one is more easily categorized into the ESG or socially responsible investing bucket. There are several people who still consider this to be impact investing and within the impact investment space, where the idea is to make an investment without tying it to a specific measurable outcome, but nevertheless there are principle based approaches to making sure that the money is deployed in a way or the company is operated in such a way that you are following ESG criteria. Now that's where I think, and I'd like to highlight that Nishith was also saying, and Nehal was also pointing out that there are several studies today, even that in the COVID situation where companies are following ESG or SRI principles, or even in outcome funding models, we have seen that typically the returns that they make is even on the financial side is better than market rate returns. And that's one of the big incentives to push this through in the future. Now, at this stage, we have one question from saying that from Rohit asking whether greenwashing is something that is possible in this space, or impact washing, and how do we separate true impact investments from the rest. So as we had earlier mentioned, the metrics and the measurement of outcomes becomes very crucial. And that's something that we have also dealt with in our book chapter, where there is an entire piece on how the science around metrics and evaluation has evolved in this space. There are 3 or 4 popular methods to measure metrics, including social returns on investments. Of course, but it is a nascent science. What our research suggests is that in certain sectors, the ability to measure outcomes is far more advanced, for instance, in the education space. Whereas with respect to other spaces like in healthcare or water, sanitation, what we have seen in each project that we have advised on is that the nature of the intervention that they are undertaking in that specific project and the way to measure the outcome becomes a significant part of the exercise, and it takes about a year, 2 years for the parties to figure out what would be the correct proxy to measure the outcome based on. So in a pure outcome funding model where I was saying that the money is tied up to a specific outcome, I think it's a lot more difficult to sort of do impact washing. Where it is SRI or ESG type investments, there is a bit more of a possibility for impact washing. But then again, I think it depends on how robust the standards are in the industry when it comes to these sort of investments, and it is in many cases driven by the investors themselves who put in these principle based criteria, like as a LP, as Nishith Bhai was saying in the fund, saying 50% of the money has to be deployed a certain way, and it's up to the investor to kind of contractually ensure that reporting is done, and they step in when required to ensure that the money is deployed the right way. But having said that, there is also a question in relation to social stock exchange, which was also something that we were going to develop, we're going to address further in the webinar. The social stock exchange, Rahul, would you like to answer whether
Sure.
social stock exchange could be a solution for making impact investments?
Sure. So I think recently, as the Honorable Finance Minister in the last budget had announced setting up a social stock exchange, and there has been a considerable discussion with different players, and we also had been a party to it, wherein we try to understand how exactly is this platform going to enable funding for social enterprises. However, it is also important to understand that a large chunk of social enterprises in India still operate through a non-profit model, and those non-profit models are essentially there by way of tax incentives and subsidies. So, in order to enable such non-profits to be governed under under SEBI for the purposes of listing, we also need to look at considerable regulatory and tax changes that would allow for non-profit social enterprises to give dividend payouts, to state the returns on investments, because once these companies are to be listed on social stock exchange, certain information in respect of bond issuance, use of funding mechanisms, wherein they could be linked to mainstream markets, also need to be understood more clearly, and these are structural challenges that we would continue to face unless we would want to revisit how the entire social enterprise ecosystem is in India is currently viewed. These structural changes in respect of social enterprises that remain to be non-profits would continue to face challenges for the reason that their listing on a platform would be very difficult. So we also need to understand whether we need the exchange platform to link those social enterprises to capital market, or whether we would need that exchange platform more as an information platform wherein potential funders and these companies would lay out their information for different class of investors to look and gauge as to what their investments or funding or funding are supposed to be. So I think we still have a long way to go in terms of how exactly we would want to streamline our platform, whether we would want the platform to enable listing or whether we would want platform to act more like a knowledge base wherein different players could come in the platform and understand each other work. Countries like Singapore, Jamaica, and different other several such countries have a listing platform, but they are still in a phase where they act more as a knowledge intermediary and not essentially as a platform which links capital market norms to these social enterprises. So, given the fact that we have unique laws in India for non-profits as well as for profit entities, we need to find the right balance that allows for all such social enterprises to be listed in the first place. So, I think in order for social stock exchange to be a successful platform and a model, we need to also fundamentally revisit how our tax laws and listing norms for a lot of these non-profit enterprises are going to play out. Over to you, ma'am.
Thanks, Rahul. So I think on the social stock exchange side, to add to what Rahul has said, I think and in relation to the other questions that have also been raised, we know that there was a committee that was set up and that is making proposals on how the stock exchange should be set up. As Rahul said, some countries have adopted a mere information exchange platform kind of model without getting into listing of instruments by social enterprises because of the regulatory difficulties that we'll face if we were to go down that model. But and even if we have to get there 10 years down the line, I think the idea is to have the evolution of metrics and standardization of reporting of outcomes to enable that kind of confidence, investor confidence, when a social enterprise lists on a social stock exchange. It will also require capacity building on the ground for these NGOs and other social enterprises to be able to comply with any sort of rigorous requirements that may be imposed for being able to list on a social stock exchange. So, I mean, we could do an entire session on social stock exchange. So I'm not going to get more into details about that. But coming back to the chapter at hand, I think couple of things that we did deal with this book in this book chapter is one, what are the tax policy proposals with respect to enabling the impact investment ecosystem, and B, to improve CSR targeting. So for the last 30 minutes, we have spent time on understanding what is impact investment and what is the different sort of models that companies or impact investors have done abroad and what they want to replicate in India. Now, we'll be getting a little bit more into the technical aspects on what are the different legal issues that come up, and also what is the policy solution that we have therefore proposed in the chapter from a tax, legal, and also from a policy perspective. So to quickly summarize the legal issues that come up, right? One, the main principle that follows that cuts through all the different laws that I will be mentioning now is that the concept that traditionally philanthropy and profit making has been seen in such a way that they are inherently separate. So you make profits and then you set aside a portion for philanthropy, and that is in a way effectively the same concept that has been adopted into our CSR laws, where basically they say that companies can make profit and then you set aside a percentage towards charitable purposes. But the issue there is that we need to break this dividing line where across all the laws there is a restriction for private capital and philanthropic capital from intermixing. So if you take this principle forward, the way it has been put in the tax law is that an entity which receives a non-profit registration cannot make any sort of investments. And if they were to do something along those lines that we have talked about with the impact investing model, they risk losing their tax exempt status, which becomes a big risk or concern for outcome funders and players in this space. Second, coming even to something like a LLP Act, you have to set up an entity with the intention of making profit. So if your intention is to run a business as a social enterprise on a no profit, no loss basis, the law simply doesn't allow you to do that. Of course, the intention may be to make a profit, and if you're loss making, that's acceptable. But like a B Corp, we don't have a similar vehicle which allows us to, go and make an impact oriented social enterprise. The other issues that we have also seen come up are on FCRA has been a significant problem, which is the Foreign Contribution Regulation Act, where money flows between for-profits and non-profits from outside India to inside India, or even between two non-profits, are subject to approval by the Ministry of Home Affairs. And that's been a significant issue because 90% of the impact investment money comes from non-profits in the US or outside of India. And also the AIF regulations, while they have taken one step forward in enabling social venture funds, which from a AIF or a SEBI regulatory perspective allows for that vehicle, that pooling vehicle, to accept grant money. The restrictions under CSR law, as Rahul said, or under tax law, prevent these funding organizations from actually giving grants to a social venture fund. So the broader point that I'm trying to make is that there are multiple laws which stem from this principle that philanthropic and private money should not intermix, and across the board all these laws try to put in restrictions to prevent that from happening, except for the AIF regulations, which partly goes to try and solve that issue. But nevertheless, I think to enable an impact investment ecosystem, at the very minimum, I think it is required to be recognized that the models with respect to both philanthropy and investments have advanced around the world, and they have been shown to be successful and more effective in both producing socially desirable outcomes and also giving back financial returns to investors. So I think the first thing that needs to be recognized is that this is acceptable and this is successful and has been done outside. And to enable the replication of such models in India, all these regulations have to be amended in a concerted manner to enable a suitable impact investment ecosystem. And it's not sufficient to just amend one law and leave it at that. And from a tax perspective, I think it's important that the removal of the charitable exemption is not done when you're doing impact investment projects. Now, coming to better targeting of CSR funds, as Rahul was saying, CSR funds is something that, based the profitability of the company, the money is set aside for a certain purpose, for charitable purpose, as set out in Schedule 7 of the Companies Act. Now, based on a lot of the research that we had pulled out, typical to traditional philanthropy, usually there is not much of tracking. So the question is not of improper spending of CSR money or fraudulent spending. It's more about, if you could have spent 100 rupees to educate 10 children, have you done it to instead educate 5? And the answer to that is possible only if there is some kind of metrics and accountability. Of course, in many projects, CSR money is deployed with some element of metrics and accountability, but it's a lot more robust and sophisticated when it comes to impact investments. So when we were considering tax policy tools to see whether we can encourage better targeting of, let's say, CSR spending, because under the law, when it's a mandatory requirement to spend CSR money on certain projects, there is not much of an incentive on the company to make sure it's most efficiently spent, which effectively is an inefficient use of capital. So I think what we have proposed in the paper is we looked at other tax policy tools that other governments have used in different contexts. So for instance, there was a sliding scale tax incentive that was proposed in several countries when it comes to encouraging people to use electric vehicles instead of gasoline vehicles, for instance. So basically, depending on how much gasoline or how less gasoline your car consumed, you had lesser amount of taxes being imposed on the purchase of those kind of vehicles, and you also had positive subsidies and incentives for buying electric vehicles. So in a similar manner, a sliding scale, more than a pure subsidy or a pure tax, a sliding scale where the more of the incentivized behavior is shown, the more tax benefit you get. That seems to have been the most efficient or useful tax policy measure to put in place. So keeping that in mind, if we take a look at what the CSR spends are ultimately going to, so for instance, let's say education, right? We looked at something like the education cess and said that as a cess as a concept is where you have to keep the money specifically for a certain purpose, which is only for spending on education. So in any case, if the money is to be spent on education, it makes sense to kind of say that if CSR money is effectively spent for education, which is one of the buckets for CSR, then you will get a sliding scale, an exemption from paying education cess. That's one way to kind of structure a sliding scales tool where government is not losing out on revenue, whereas it's achieving the objective for which the education cess was originally collected for. So we have looked at some of these proposals and put in recommendations, including on how incentivizing spends of CSR in areas in the country which actually require it, as opposed to well-to-do industrial areas where companies are already situated, like Maharashtra. So these are some of the other things that we have covered in the paper. As we are coming up to the end of our time, I would like to pause and hand it over to Nishith Bhai for any concluding comments.
Yes, thank you very much, ma'am. So nice of you. I think you done a brilliant job. Nehal, the same thing. And Rahul, I've missed introducing you to the audience. Rahul leads our social sector practice and his master's in social sciences and the lawyer, the leading lawyer on the social sector. And I think the ideas and the opportunities you discussed were extremely helpful, and I'm sure the accounting community and the other professional community will benefit greatly from this. In fact, I see there is so much to do in this particular sector for each one. I think there are n number of opportunities, and including one of the ideas we have been working on for some time and done some work is on mergers and acquisitions in not-for-profit sector. And while we are all practicing and we have been doing large mergers, acquisitions, and all those kind of things, there is also an opportunity in social sector in terms of mergers and acquisitions, because there are some not-for-profit or social projects or social entities. They have very good pool of people, but they don't have money. Some have only money. Somebody who dies, you would always put some money in a charity. It has money, but no people, nothing. Some people have infrastructure. Every town and village you go, there is a school. There is a basic clinic. In school, there is no whiteboard or blackboard. In the health clinic, there is not much facility, and not otherwise in a pool of talent. And some people have everything, but no management. So if we can look at consolidation in not-for-profit sector, it's one of the major areas in which many of you professionals can involve. And of course, we are always there to help you. But it would be wonderful that if we can create an ecosystem where now we move toward the stakeholder concept. We have paid enough attention to shareholders. We have paid enough attention on employees. We have paid enough attention on vendors and sellers and everybody. But I think the community at large, I think, is the next thing that we really have to have a laser sharp focus. And we have learned a lot of lessons from this COVID-19. And in fact, while, as I said, we feel sorry for those who are trapped in the pandemic, but it has opened up a lot of opportunities. In fact, in many ways, it has created a good pollution-free atmosphere, less traffic, less noise, many other things. We have begun to learn minimalistic life, and of course, even meditative life in many ways. It has taught a lot of lessons at this point in time. If we can take good from this pandemic and take it forward, with the responsibility that comes along with creation of wealth, I'm sure all of you and all of us will all be benefited on a global basis. Appreciate all of your contributions. Thank you once again, Maya, Nehal, and Rahul, and everyone else. Thanks a lot, and thank you, Devansh, for moderating.